All right, welcome everybody to our webinar. Hi, Vince. How you doing? We've got a few people joining us today. Got Erik and myself. Leia's in the background, keeping the ship afloat. Joan and Anne-Marie are off doing their big things, but the big guy we've got joining us today is Stive Farronato, who some of you may or may not know. Welcome, Peter. Welcome, Toad. Welcome, James and Barry. Stive is a CPA and lover of the Toronto Maple Leafs. He works with Tax Matters or TMFD Financial now, and they are a tax firm that we is on the same building or soon to be again the same floor as us. We moved up and they haven't yet, but they will be on the same floor as us, and we use them for a lot of our clients, and they do a really great job. So,
welcome to be here.
Yeah. We'll. This session is going to be interactive, so oh yeah, here's a disclaimer. So while I blather on, yeah, we have to show this apparently. This session will be interactive, and ideally, it won't be a presentation. It'll be your questions coming to us and letting us know what you guys want to hear about. If not, we will fill with some softball questions that we've got for Stive as well. Welcome him in. Thanks for joining. I know a number of people are maybe not live today, but they are joining via recording. So hopefully you enjoy listening to Stive talk as well. We'll try and keep it short because I know everybody wants lunch. This is our team. There's me, Per Homer. There's Erik Wachman there, my trusty partner. The founder of our team, Jeff Wachman, who's been with Asante for longer than he'd care to admit. We've got Leia, who's here in the background, helping us keep everything running smoothly and organized all this for us. We've got Joan and Anne-Marie as well. So that's the team. And so if you hear from any of those 6 jokers, you know it's us. Stive, there's an extremely handsome picture of Stive. And well done. I think that was taken last summer. Stive is the president of TMFD Financial. He has previously been a licensed advisor with Asante as well, but has decided to focus on his passion, which is tax and accounting. He's a CPA. And he even worked for the CRA, so he knows a lot of things. And also, if you want to know anything about the Leafs, Stive knows everything, just so you know. So that's also an opportunity to ask about that later. Although, don't ask if they're winning the cup this year, because I don't think that's happening. But never say never. So without further ado, I'm going to throw it over to Erik, who's got the first question in the queue, and then anybody else that has wants to ask a question, just put your hand up, and we'll either take it by chat or we will enable you to speak. And Erik's going to take away with the first question, and then we'll hopefully everybody else chimes in. But otherwise, we'll keep peppering you, Stive. Okay.
Beautiful. Thank you, Per. And again, thanks everybody for joining us. Glad to be sharing this today as a kickoff to tax season. Hopefully we can answer all your questions and we can get taxes done in time for spring and the warm weather, which is showing itself today. So happy to be here today. And thanks again, Stive, for taking the time out of a busy trade deadline day for all of you hockey fans out there. So we'll keep an eye on that. To get started, Stive, wanted to ask you about what's new for 2023. I think CRA and the tax teams always come up with some new deductions. So can you share with us maybe a few things that have come up this year that clients should be mindful of when getting ready? So anything new for this year to call out?
Yeah. I think there's always new things every year. I don't have an exhaustive list, but things that do come to mind right away is the FHSA, which is a first-time home savings account. I think many of you were aware of the introduction of that facility and saving opportunity in 2023. I think the came in as a result of the budget last year, but took a while from an administrative point of view. I think a lot of the financial institutions, a lot of the banks were slow to get the process going. Even our friends at Asante took a little bit of time to make sure they had all the bells and whistles all set up properly. But ultimately, it is a great savings technique or tool that's available to, I think, anyone 18 years of age and older to ultimately get an $8,000 deduction per year for a maximum, I think, of $40,000 for maybe 5
45,
years
correct.
worth. Yeah, 40,000,
Total.
correct?
Mhm.
And it could be used for a first-time buyer. So you cannot have owned a home previously. I think there's a 5-year rule. So if you own something before, sold it, rented for a number of years, and then 5 years pass, then you're considered a first-time home buyer again. And ultimately, you can put 8,000 in, take 8,000 out. Any income that's earned is not taxable. Taking the money out is not taxable. There's no need to repay it back like the RRSP home buyers plan, where you have to pay that back over a period of years. So this is a win-win-win all around. And what I'm telling a lot of clients, I think that people that have opened it up and maybe 18 or 19 or 20 years old and want to start saving for this home time or the first time buyers program, even though you contribute the $8,000, you don't have to deduct it this particular year. So if your income was quite low, because maybe you were a student or you only have $10,000, $15,000 of income, or even $20,000 of income, the $8,000 deduction is not going to really help you a lot. It may save you 20% in terms of getting a refund back. So ideally, you could make the contribution, hold on to it, and not necessarily claim the deduction until another year in which your income is a lot higher. Similar concept exists with the RRSP as well too, in that even though you make the contribution, you don't have to deduct it in the year in which you made it. It can get carried forward and used when you have a higher income amount. That makes a lot more sense. You get the bigger bang for the buck. Hopefully that makes sense.
Yeah, that's great. And
Yeah.
few small things to add on that. So for the FHSA, you don't necessarily have to contribute when you open it, but you do have to open your account if you want the room. So what we've been recommending to a lot of clients that have children that are 18 or turning to that age is to open up an FHSA. You don't have to put any money in it now, but at least that starts the contribution accrual clock. And if you so choose to make a contribution or a matching, however you choose to do it, at least you'll have the option to get that 8,000. Like the RESP, you can do a catch up for 2 years. So you can, if you opened it, you get 2 years worth of contribution, that's 16,000. You can top that up in the second year. You can't do more than 2, but it gives that additional option. So just putting it out there, it is a great tool. And unlike in our RSP home buyers, you don't have to pay it back over 15 years. You get to keep all the grant growth dividends and you pay 0 taxes on it. So a nice way to start saving there. So thank you for that, Steve. On the tax side of it, anything clients should be aware of if they've opened up an FHSA?
Other than, like I said, letting us know that you've opened up the account. There are receipts that have now been distributed. I've seen a couple of receipts for these FHSAs. They look a little different than an RSP receipt. Almost looks like an income receipt. It comes like a T4, so it's a different look. But as long as we have that, then we can claim the potential deduction if it's worth it.
And the other thing I would say there, Steve, that's really important is I discovered the other day is if you opened the FHSA but put $0 into it, you still should declare it on your tax return because that starts the accrual. So you'll get the carry forward room from 2023. For this year, you could do a maximum of 16,000, which is great. Most of the time, Eric and I are saying to people, look, if you want to open an FHSA and you don't have $8,000 to throw into it, just open it, throw $100 into it. And that way it's open and the clock starts ticking and you start building up that carry forward room, which is really great.
Is there a charge, guys? Even if you open up an account and you put in $50 or $100, does Asante charge a fee to have the account open, or is that a cost?
If you have other accounts, no.
If you have other accounts, okay.
If you have only the FHSA, then I believe the $50 or $100 Asante fee would apply. Erik can double check me on that, but that's my understanding.
Okay, no, just wanted. I wasn't even aware. I mean, I was wondering how that fee happens with respect to new accounts.
Right.
Okay.
No trustee fee per account. It's all been lumped into one fee for all the accounts.
Yeah.
Good question there.
All right, Erik, we've got another one coming in here from Peter. Do you want to take that one? Another
Sure.
question?
Maybe we'll finish up on 2023 update, and then
Perfect.
we'll
Do
take
it.
the
Yeah.
questions. Okay, there's one more thing, Steve. During COVID, we were able to deduct a lot of home office expenses, given that most people were working from home. What has changed for 2023, and any tips and tricks in that regard as clients look for?
Yeah, there's the right there, leg and stop. I've highlighted it in black there. The simplified method of $2 per day to a maximum of, I think it was 500 in the first year of COVID, and then went down to 400. That's now gone.
Right.
So if a number of people are still working from home, which a number are, the simplified method is no longer available. And what needs to happen there is a couple of things. A little more record keeping involved. You need, first of all, a T2200S. I can share it with Per and the group.
Put it in the chat.
Yeah. And it's a form that your employer needs to sign to say that you are working from home for 2023. And in order to get the deduction, you have to have been working from home more than 50% of the time for a period of 4 consecutive weeks. So, you know, if you went to the office for a week and then was home for a week and then back to the office for a week, that would not constitute. You'd have to be off. You'd have to be at home for 50% of the work time for consecutive 4-week period. So if you meet those conditions, then you need to then provide details of your home office in terms of square footage, what size of your home is, let's say you use a den or a bedroom as your home office, you know, what percentage is that? Is it 5%, 10%? And then you have to list your costs involved. So if you rent, it's as simple as the rent, and maybe you have internet or Wi-Fi or utilities, or and if you own a home, you're pretty much limited to the utility costs of the home. Unless you are a commissioned salesperson, then you can deduct a little bit more, like property taxes and things of that nature. But a little more record keep involved this year. At the end of the day, it likely works out to be roughly the same $500 to $1,000. It's not going to be a magical $10,000 deduction, because if you break it down and you have let's say you're paying $2,000 a month in rent and it's $24,000 a year, and you use, you know, 10% of your space, then it's pretty much capped at that level.
That's great. So in summary, if you're working from home, you need a T2200. So if you don't have one, you need to ask your employer for one if they'll provide. If they don't provide, can you claim home office expenses, or no, you need that form?
No, you need that form. Yeah.
Okay. So everybody,
in some sense, this deduction, with the amount of record keeping, the amount you need to annoy your employer to get it signed, it's almost not worth it.
You know what, Per? Sometimes I wonder, you know what, because it is a lot to gather, a lot to ask, and you know the net effect.
Yeah,
and it's not,
because I'm not getting $500 or $1,000 into my pocket. I'm getting my income reduced by $500 to $1,000. So I might be getting, you know, $200 to $500 into my pocket for doing all this record keeping, right? And you know, is that how I want to spend my days?
Yeah, fair enough. On the salaried or the commissioned employee side of things, Steve, would it make sense for them to push for these records? Are there more deductions that can be made?
Yeah, because I mean, with a commissioned employee, sometimes they have more expenditure. Maybe there's a cell phone, maybe they're driving a lot more as well too, and that's a car is required, and you're not getting a vehicle allowance or a taxable vehicle allowance. So you know, there would be you know, I would say it's worth the record keeping at that stage, because normally a commissioned salesperson has probably historically always been claiming the T2200 and some employment expenses even previously.
Right.
So that sort of just adds to it.
Okay. So if that applies to you, ask for that T2200. You can see what can be deducted, and then chip away on that. So that's good to know. We often get questions on that one. Let's rip through this just to see if there's anything else, and then we can hop to questions. So
I think, I mean, a couple of things, relating to property sales, whether it's your home or whether it's an investment property. even if it's your home a couple of years ago, and I think a lot of people sometimes aren't aware, even though you sell your principal residence and you move to another principal residence, CRA deems it not to be taxable, which is fine, but it still needs to be reported. So if you've moved in the year, or you sold your house and bought a new house, it's important to disclose that information. Again, it's not a taxable transaction, but it is something that CRA wants to be aware. I think our friends at CRA are in the business of gathering more and more information on us. It's almost like a big brother, and they want to gather information. So the more that they can gather, then they can then see maybe the history of you flipping homes. Are you, buying and selling a principal residence every 2 years to take advantage of maybe the market change? And if that's the case, maybe CRA will deem you not to be flipping residences, but flipping homes, and they find you taxable. And when we talk about the taxable flipping of homes beyond the principal residence, this year, 2023, they've introduced I think a pretty significant change. So if you bought a property at the beginning or sometime in 2023, and then turn around and sold it within the same 2023 tax year as an investment, most people were thinking that that would be a capital gain and ultimately taxed on only half of the amount of the profit. But CRA is deeming it to be considered inventory, and that you are a flipper of homes, and you ultimately will pay tax on 100% of the profit. So it's a significant change. So if you speculated and you bought something early in the year and then sold it November, December, you may be in for a little bit of surprise. And that instead of only 50% taxable, the full 100% will be taxable. There are some exceptions to the rule. Sometimes if you were forced to do it because there was a breakup in the marriage, or there was a death in the family, or CRA has probably a list of 7 or 8 exclusions. But if you did it strictly for a quick flip, I know a lot of people who bought condos on consignment or assignment and turn around and flip them. You have to be mindful of that as well too.
The holding period used to be 6 months to avoid being considered to flip it. What is it now? Is it 2 years?
Well, it's the 1 year for sure. Like if you're within the 1 year, it's automatically deemed to be. It's actually there's a question now to report. But if you want to be safe, I mean, anything beyond a year is technically safe. I mean, you don't fall within those rules. But to me, it's the time period as well as frequency. If you're doing it more often, I think CRA may be considered a flipper. I had a client who,
go ahead.
Sorry, I had a client that last year or 2 years ago speculated, bought 2 properties, redid them, and then sold them again in the same year. And even though the rule was not in place specifically, the CRA went back and reassessed him as if he was a developer, and he had to pay 100% of tax, or 100% on the profit instead of a capital gains rate.
Good to keep
that kind of leads into the next question, Eric, from Peter, if you want to take that one now.
Sure. Question from Peter. So being joint partners in a rental property and looking to sell, question is, can we share the capital gain, or will attribution rules apply?
If both of you purchase the property with the intent to ultimately invest, then both of you can share in the capital gain.
Yeah. So there you go, Peter. Hope that answers. If you have any specifics or any follow-ups, please let us know. But thank you for that, Steve. I know, Steve, what about get clients often they sold the property, say in 2022, they go to do their 2023 taxes and they say, oh, you know what, I forgot to disclose this. What do you recommend in that case? That's something you do in the next tax year, or you say, well, it's done, forget about it. Oh,
you're talking your principal residence?
Correct.
Yeah, no, we should. I mean, CRA is wanting that information. So I think they're a little lenient at times to say, okay, oh, you forgot to do it, but don't turn a blind eye to it. I'd go back and it's like claim forgiveness and say, oh, I forgot to report this, and report it, because there's a special form. It's a principal residence election form, a T2091, I think, where you designate your principal residence, but it should be amended to reflect that. And if CRA deems it where they will fine you because it was late, then there's a potential penalty as well too.
Fair enough. So better to disclose. We have as part of our checklist to ask if you have sold a property, so we try to catch it that way. But
sure.
Just a reminder to everybody out there that they're now asking about this. Investment counsel fees. So that just a reminder to everybody that for non-registered accounts, you can deduct. So generally what we do for clients is we have a year-end statement, which shows the fees, and we also have an annual fee summary, which is now available. So if that applies to you, just a reminder, pull that, and the fee that relates to the non-registered accounts can be deducted. So that's great there. Interest on investment loans, if that applies to you. Steve, anything on the digital news subscription tax credit? I know that's there. We haven't had
yeah, you know what? I mean, it's there, you know, and not too many people have claimed it. Though that being said, I mean, a lot of us do subscribe for, you know, whether it's the Star or the Globe and Mail or whatever, right? Those things do qualify. You just need to be able to get the receipt, and it's a refundable tax credit. So it's, you know, 15% of $500, right? So it's not a huge amount, but it's something that's available. The next one is another interesting one as well too. We likely have some teachers on the call, or people are aware of teachers. There is some deductions available for supplies. I know my daughters are teachers, and they're always spending some money out of their pockets. The school boards are running low of funds at times, and I think a lot of the teachers have spent some monies in terms of doing things for their classrooms, in terms of supplies and things of that nature. So, you know, it is another tax credit that's available to help get a little deduction.
Nice. What about the next one?
Yeah, the next one is a new one for this year as well too. We're sort of getting onto some of the new things. So I think it was part of last year's budget where they know that the multiple families are moving in, whether parents are moving in with their kids, whether they're renovating their basements to house their parents or their kids. There is a $50,000 refundable tax credit. Again, it's not a deduction like an RSP, so it's 15%. So it's still a sizable amount in terms of a reduction of your taxes owing or potential refund. So that is something that's new for 2023.
That's pretty meaningful, because you could get up to $7,500 back on that rental. Which is And so if so for example, if my parents, God forbid, were to move in with me, and Steve laughs because he knows my parents, we're great, but they're good in their own home. Then if I have to reno it to, you know, create them an ensuite and a kitchenette in the basement, I can use that towards that tax, I guess, right?
I think I've been on a couple of courses as well too, and I think what they're saying, even on new builds, if people are moving into a new build, and as long as they can explicitly break out the cost to finish the basement on a new build. So if the builder is willing to say, okay, price of the home was $1 million or $2 million, but the home or the basement was for $100,000, as long as you can isolate that amount, then you can count that towards that $50,000.
So ask the builder for an itemized receipt, I guess.
Correct.
And then when this one, and also this comes back to Peter's other question for the seniors home reno, which is on line 36 there. Do we have to use a licensed contractor for that, or if I'm really handy, which I'm not, can I do it myself and then just claim my my supplies, I guess?
Materials only, correct. Your labor wouldn't be part of it, but any and again, it's renos to help seniors with, you know, the ability to function. So you're not, you know, finishing your basement. You know, you are, let's say you're putting in a ramp. Let's say you are changing your shower to put in handles and bars, or raising the cabinets, or doing certain things in order to qualify. I know we've had some clients send in different items for rentals, like their windows and and that's not considered a
No, but like a walk-in tub, those kind of things
correct.
would be great. New higher toilets and
Yes.
stair lifts and things like that are all
Yeah.
good.
Yeah.
Another thing that occurs to me, I used to work at CMHC, and they had a program as well where you can get, they probably still have it, where you can go to CMHC and ask for a grant towards doing stuff for seniors, such as accessibility stuff, like ramps and stair lifts and improving washrooms for safety and those kind of things. So that's another thing to consider if anyone's looking to do that for their parents or for themselves. That's another source
One
of
other thing I wanted to mention
a
on
little
line,
funding.
sorry, Per, on line
Go ahead.
34. So if those that took advantage of the first time home buyers,
Yeah.
bought a home for the first time beyond the, the RSPs that you could have used and the FSHA, you're also able to qualify for a tax credit of up to $10,000, which again, at 15% is a $15,000 tax return available.
Yeah. Well, it's every penny helps, right? So
For
that's great. Yeah.
Let's move on to donations. Steve, do you want to remind clients how they work from a tax perspective and what are some best practices with regards to donations, if any?
Yeah, I mean, donations are great. They act as a deduction or a refundable tax credit. You get the biggest bang for the buck when it's beyond $250. So the first $250 is at a lower rate, but beyond the $250 worth, you are actually getting it at a relatively high tax rate saving. So if you're going to do that, that's great. For those people that have donated maybe securities in kind, so you had the opportunity, maybe if you had a stock or a mutual fund that you wanted to donate, CRA allows the fair market value of that donation to be a value of the donation on the receipt, and the capital gain from selling that security or that stock or mutual fund is not taxable, and CRA gives you a bit of a benefit to do that.
Awesome.
There.
Tuition. A lot of us have kids that you just finished this, Steve. Your kids are now as teachers, but you went through this recently, and it's coming for me. Is university, and so I vaguely remember how it worked when I went to university. But I remember you get some receipt for the tuition that's paid, and some of that the parents can deduct. How does that work?
Great question. I mean, so when your child attends post-secondary, and so they're college or university or even a trade school.
I've seen yoga instructor, so it can be anything really, right?
Yeah.
So
you get a form from the school or the institution. The T2202A is the official form. A lot of kids are able to download that receipt from their online portal at the school, and the children are the ones that need to try to use the credit first based on their levels of income. If their income is low, as most students are, then up to $5,000 can be transferred to the parent. So that's a good little potential tax credit deduction that you can qualify for. And if it's amount beyond the $5,000, that gets carried forward by the student for future years in which they do have greater levels of income.
Yeah. And that receipt should technically be signed, I guess.
Yes, on the back of the tuition
student
receipt, there is a area for you to sign to transfer over the tuition to your parent. Again, most of the returns that we file electronically filed, but at times CRA will ask for backup, and having that receipt available signed is nice. I've seen them deny a receipt initially because it wasn't signed, but it depends on the auditor you get at the time.
Yeah, no, CRA definitely gets their hobby horses, and I think you can probably tell us more than I even see it, that suddenly they decide, okay, we're gonna check everybody who did moving expenses, and then all the clients that claim moving expenses all get a letter.
They do have, as I said, most returns are electronically filed, which means no receipts are needing to be uploaded to CRA.
No,
but they need to be kept. And during the months of August, September, October, November, there are letters that are sent out, and generally we get a copy of the letter looking for verification of certain line items. And sometimes Pear's right, they do target a certain area, whether it's moving expenses, whether it's, you know, RRSPs or medical expenses, I find, especially if there's a big jump from one year to the next. It's sometimes a trigger for them to look.
I remember there was one year they went after all of my single mom clients to prove that they had custody of the children, and I lost my mind a little bit. I thought that was awful, but that's what they did. There's one more question. I think we have time for one more question from the crowd, and then maybe Eric, you have some closing questions and comments.
Sure.
Does that sound good?
Yeah, absolutely. Or do you want to? Or do you want me to? Okay, I'll read through it.
Yeah, sure.
Got it.
All right. So another question here. They acquired their late father's property last year and are renovating it. And I'm assuming that was acquired through either inheritance or purchased from siblings. They plan on selling their principal residence year and moving later in the year into the late father's property as their new principal residence. What kind of reporting do they need to do?
So they bought the property from their father, their late father. So the reporting, if that happened in 2023, the late father needs to report the potential sale of that property, whether it was their principal residence or not. The acquisition by your client, nothing needs to be reported on that acquisition. Just obviously keep track of the costs to purchase it, any renos, and then when it comes time to flip it, then the principal residence, they need to report the sale of their principal residence, and you're going to move into this new one. Then that shouldn't be an issue. You just need to report the sale of your principal residence at the time.
So let's say I got the new place, or I got the place from my late father last year, and I did a whole bunch of renos. And when I move into it now in the fall, it's gone up $100,000. Do I need to claim that gain on my 2024 tax return, or does it carry forward until I finally sell the house?
Well, I mean, if it's gone up that much in value, you've acquired it and you've done some renos. I mean, assuming that the cost of all your renos and stuff, there could be a potential gain there, right? So if it's, you know, sometimes I would not sure that it would go up that much in value, is assuming that the fair market value at the time you acquired it from your parent and you add in the cost of the renos, I would imagine there hasn't been a huge appreciation. If that's the case, either we're in a hot market, which I don't think we are, or there was some undervaluing somewhere, right?
But let's say it has gone up. Let's say I got it 10 years ago, but let's say it's gone up in value, right? And now I'm going to turn it into my principal residence.
Yeah.
When do I pay the tax on that gain, right? It's the same question for someone that sells their principal residence and moves into their cottage.
Yes.
Right. So when do you're going to have a gain?
There's a form that you can sign to when you change your residence and you change your use, you can defer it till the time you sell it.
Okay. Yeah. Perfect. Yeah. That's a fair way to do things. That's a rare thing from the CRA, but that's good. Yeah.
Thanks for the question, Peter. Just a few more here, Steve, on medical expenses. Any best practices, or how do they work? Is there a minimum? We often get a slew of receipts. What do you like seeing, and what do you generally recommend for clients on the medical expenses? And then how do they work? What are the thresholds from a tax perspective?
Yeah, it's income tested, right? So the lower your income, the better it is. If you are at a higher income level, usually there's a threshold, and it's close to $3,000. So any medical expenses beyond that amount can be claimed. So if you're a senior and your income is low, usually it's about 3% of your income. So if you're making $30,000, let's say it's about $900. So the first $900 is not a deduction, but anything beyond that would be.
Do you generally recommend clients to send in their medical receipts regardless of the amounts, or do you say if they're over X, then it makes sense to? What do you generally advise?
I would, gauge it, right? I mean, if you have a lot of medical receipts, then, I'd summarize it and make sure that you have a substantial amount. But you know, if it's under $1,000, I don't think it would be that worthy unless your income is really low.
Fair enough. Okay, sounds great. Let me see anything else that I had. We covered home offices, medical expenses, donations. Anything else that you on the commonly missed deductions or anything else you generally recommend that clients may forget or may not?
Yeah, I'm just trying to look here. Maybe let us scroll up and down a bit. Yeah. Okay, that's all income. You know, one of the things I'll say about income, you know, we talk about the USA. We have clients that have US citizenship for some reason or another. Maybe they were born there and left and came to Canada. It's one of those gifts that unfortunately keep giving. And if you have US citizenship or you're a green card holder, there is a requirement to file a US tax return. Even though you don't have any income in the US, your friends at the IRS are wanting to know. So be mindful of that. And, you know, seek the advice of a cross-border specialist. It's not an area that we dive too much into, but it is something that is becoming more and more to the forefront, because there's a lot of people that don't know that they have this status, or they think they have it because, like I said, they were born there and nothing has happened since. But you may be stopped at the border and say, hey, you haven't filed your tax returns in 20 years. So just be mindful of that. Let's see on the deduction side, scroll down, please, Leah, a bit. Spousal support, childcare receipts. Childcare receipts, you know what? People that, like I said, we talked about tuition. Kids that attend private school, the first early years of the child's attendance in private school, a portion of that tuition is considered childcare. So speak with the private school, and they can ideally break down the cost of the receipt between how much is tuition and how much is childcare. Because as you get older and you go into higher grades, there's still a component that would qualify as a childcare expense, whether it's a lunch or a recess or after school. So what I find is a lot of the private schools are pretty good at breaking down the receipts. And that's accounts, interest paid, disability tax credits. I think that's about most of it that we've touched on most.
One thing that's like seniors living in residences, what can they claim, and is there anything that they should be mindful of?
Residents, you mean with their kids, or are you talking a residence?
Not a long-term care home, but residence where meals are
if there's a medical component, if you're not in a long-term care, but you're just in a retirement residence.
Correct.
Unless you're paying for medical care, then the amount that you pay could be considered a rent and can be used as a potential for an Ontario tax credit for the Trillium benefit.
Okay.
And so what I've seen from that is what sometimes like you're staying at Amica or somewhere like that, you can ask them for a letter or a receipt, and they will. Yeah. They're super used to it. They'll just give you an itemized breakdown, and then you hand that to the accountant, and they know what to do.
Yeah.
So, pretty great. So it does create some deductions. It helps, especially those that are in place like that. There is obviously you're on a fixed budget and it's expensive, so it does help a lot.
A lot of people that are there sometimes are there for medical reasons, and they have a disability tax credit, whether they potentially have dementia or they Alzheimer's or they have mobility issues. The disability tax credit is something to consider for seniors, or even for non-seniors. If you're in a situation where it is medically required, then that's something that should be considered.
And the disability tax credit too. So if you are applying for that for the first time, I've seen clients ask the doctor to put the date of the onset of the disability. So that might not be this year. It could be 5 years ago. I've seen 10 years ago, and there's a form that gets filled out the first time you have it with the CRA, and they can go back and reassess your tax returns backwards.
Mhm.
And that often leads to a very pleasant deposit into your bank account as well. Nice little refund. Most people like that as well. So if it's yourself or you're taking a family member to go apply for the disability tax credit, do ask the doctor to backdate it to the appropriate date that the doctor is comfortable with.
Yeah, good point there.
Excellent.
All right.
I think we did the gamut there, everybody.
Okay.
So questions are clear. So hopefully that provides you with a good intel as to what you can claim, gets you primed for this tax season. I wanted to give a big thank you to Steve for sharing some time today. I know we're gearing up for taxes here, and we're thankful that Steve dedicated some time with us today. So big thank you to everybody. If you have any follow-up questions, please don't hesitate to reach out. That's what we're here for. We'll be
Excellent.
tax swing the next few months. So reach out to Per, myself, and we'd be happy to answer that. And if you do need help with your taxes, please also give us a shout, and we can certainly get that done with Steve and Co. If you need. So wanted to thank everybody for taking the time today. Happy Friday, happy trade deadline day, and thanks again to everybody for speaking, participating, Leah for organizing, and everybody for being on today. Hopefully that was helpful, and we'll do another one soon.
Excellent. Okay, guys. Thank you.
Thank you. Go Leafs.
Everybody.
Go Leafs. Bye.
Bye.